Okay, so welcome. I've got John here. I'm really excited about this. John is sitting in Denver. I've just come back from a run in Singapore, so it's hot. I'm sweating. I imagine it's much cooler where you are, John.
It is, but it's a sunny day. We'll take it.
It looks good. So look, maybe we can start. I will link to your bio and everything else in the background, but can you just give us a quick sort of 5 minutes of the potted career history up to where you are today, and I guess why we're talking to you in the context of investment?
Yeah, sure. So today I'm a professor of management practice at London Business School. I teach and study entrepreneurship, but I got here through sort of a checkered route. I went to business school in my youth and then worked in the retailing industry, worked for a company in Chicago called Jewel, a big supermarket business for, I guess, about 7 years. Got a call from a friend who was working at this little startup in California called Gap. And Jack said, you know a little about retail because you're working in retail. We don't know enough about retail in this new company we got here. Do you want to come to California and work for Gap? So I said, that sounds like a good thing to do. And I learned an awful lot about growing a company really fast at Gap because we grew it really fast in those early years. And by the time we got to 400 stores, it was feeling a little more bureaucratic, a little slower in its decision making. And I said, gee, I've learned a lot here. Maybe I can go do this myself. So I started 2 other businesses in the next, I suppose 10 years. One of them failed. One was a draw. So I kind of have a win, a loss, and a draw to my name. But anybody in retail will probably tell you that 20 years in retail, like I had, is probably enough. So I decided at mid-career to say, what else should I do with my life? And I'd had a great time in B school, and I said, well, maybe I should be a professor. I come from a family of educators, and it was probably in my genes. I just hadn't, dealt with it. So I went back to school, got a PhD, taught for 7 years in Denver, had a 10-week sabbatical in London, and that turned out to be 19 years at London Business School. And it's been a fantastic 19 years, to be at a world-class place like LBS and get the access that I get at a global institution. So I'm around the world all the time and learning how entrepreneurs do things, how they finance their companies, how investors do things, the kind of mistakes people make. It's been really fun. I'm a lucky guy.
Yeah, so I mean, interesting that you said that. So it's not just so much about educating, but it's also about learning and about that visibility and access to deals and opportunities, I guess, that many people wouldn't normally get.
Well, that's what professors really do. Every now and then we teach and, try and transmit some of what we learn, but mostly our job is to learn, and it's a fun job. I feel like I'm kind of like Joe Montana, who got to throw a football for a living. I get to study companies for a living and get paid for it. It's pretty cool.
So let's just drill into that a bit, because it's a big field, business and entrepreneurship. What are the areas that have kind of most taken your focus in the last couple of years? What have you been looking at?
Most of my work is with companies that are with the 2 big networks of entrepreneurs around the world, YPO and EO. So these 2 organizations are membership organizations and people who've started companies and want to be part of a community, because who do you talk to when you're at the top of an organization? It's not clear who you can talk to. They join YPO or they join EO and they get peer exchange, get a chance to talk candidly with local people about the common issues they have, but they also get to do some really cool education at places like London Business School, or occasionally they'll invite me to come to their city and do something for them. So much of my learning has been through YPO and EO companies. Most of those companies, interestingly, are customer funded. They don't tend to raise a lot of money from investors because they've figured out how to raise money from their customers. And there are a lot of good things about that, like the fact that it doesn't cost you anything, in terms of dividends or dilution of your shareholding and all those kind of things. So that's been really nice. So my work's on how do you grow those kind of businesses? How do you take a small business or mid-sized business and grow it into a much bigger business? And I've written one book on how do you assess opportunities either for growth, or when I wrote it back in 2001, 2, 3, how do you assess opportunities that might might be an opportunity for a brand new entrepreneur or an angel investor looking at a startup kind of deal.
Okay,
Those
so
are my two areas.
yeah, so let's look at it from an investor's standpoint, because of course the last thing an investor wants to hear is you telling businesses not to take money from investors.
Well, I don't exactly tell them that. What I tell them is don't take money too early from investors. So the problem is taking it too early, because we know from experience. I've written 3 books. The second, as you know, Callum, the middle one is Getting to Plan B, that I wrote with Randy Commissar from Kleiner Perkins. And we know from the work in that book, and we knew it already, that the typical startup does not get to nirvana by following Plan A. They get there by pivoting to Plan B or Plan C or who knows, Plan Z.
Yeah.
And so if you take money too early, what the angel is probably going to tell you is, I invested in this Plan A. I love your Plan A. I want you to faithfully execute Plan A. And that's
Not necessarily right.
most of the time not going to be the right thing to do. So you need to get some customer traction and prove to yourself that maybe Plan A is right. Who knows? Sometimes it is. Or you pivot a little bit and you find the traction where you can find it. And once you've got some real progress made with a customer, then that's a reasonable time to maybe take some angel capital or some other kind of invested capital. So I don't say don't ever take VC or angel money.
Yeah.
I say take it at the right time.
Yeah, and I think that's come across loud and clear in a lot of the interviews that we've done, even with angel investing. It's for investors, picking where you get onto the journey and not too early. And I mean, in my business model, we tend to work with well-established businesses, and that's because ultimately for me it's not even about the team or the idea, it's about the market. If the market doesn't, I might think it's a great team or I might think it's a great idea, but ultimately it's the market that makes the decision with its dollars. So I imagine by the time you see a lot of these businesses, they've kind of got over a few of those early hurdles and are starting to
That's right.
build up. And I spoke to your colleague Daniel from Growth Institute, and had a good interview with him. So you've been involved with them for a while as well?
Long time. Yeah.
Good stuff. So look, one of the things that I was asking Daniel as well is, because you get so much exposure to so many different businesses, what are some of the trends that you're seeing, or what are some of the opportunities that you're putting your money into right now that investors you think investors should be looking at?
Well, your question reminds me of the movie when I was young called The Graduate, when Dustin Hoffman asked that question of a guy at a cocktail party, and the guy told him, plastics, get into the plastics industry. I don't think we can make a recommendation like that, because it's really hard to be an entrepreneur and really get past all the twists and turns in the road and deal with the competitive and market challenges that you're going to face along the way. It's really hard to build an entrepreneurial venture. And if you're not really passionate about what it is you're doing, you're just not going to have the tenacity to get past all of those, bricks in the road. So I tell people, find a problem that you really want to solve, a real problem that exists in some business or exists among some segment of consumers, or maybe you find something that's not done very well, like coffee shops in the US 40 years ago, and you're Howard Schultz and say, well, could I make a nicer coffee bar experience? Instead of charging 50 cents, I'll charge back then $3. So you can do one of two things. You can either provide customer delight, make something, radically better for the customer than it used to be, or you can solve a compelling problem. And as Vinod Khosla, one of the famous Silicon Valley investors of all time, said, nobody will pay you to solve a non-problem, no problem, no business. So I tell people, don't worry about what sector, find a problem. And typically that's a problem, if you're if you've been in the business world for a while, it's a problem in the industry you work in, or maybe it's a problem in the market you serve. As I point out in my first book, The New Business Road Test, markets and industries are different things. It's important to understand that distinction. But typically you'll find something that isn't quite right and you can make it better. And that's what you ought to do. And happily these days, because it's much, much cheaper to start most kinds of businesses today, especially if there's a digital component to them, it's easy to get rolling, whether it's in good times or bad. If you can solve a customer problem, that's a compelling one, that customer is going to pay you to solve that problem. And then you're going to have some cash in hand to go get the next customer and the next one, and pretty soon you got a viable business.
So from an investor standpoint now, and just drilling into what you've said, how important to you or to the investor do you think the entrepreneur having the industry background is? Because I know what tends to happen, and again, it's sort of a Silicon Valley offshoot, is something will do well, and suddenly everyone kind of rushes into that space.
Yeah. Oh, I got to have one of those, right?
Yeah, exactly.
Yeah.
And
Oh, a subscription. Well, we're going to have subscriptions for everything, right? Like subscriptions for men's underwear from Manpacks. Give me a break, Yeah, you're right. Investors are like lemmings until they go off the cliff into the sea.
Yeah, and in my experience, it's the people that have been in that industry for a while are the ones that are able to capitalize because they've got the contacts and they've got the experience and they've got the credibility. So would you say that's one of those things that, it's a potential red flag for investors if you see an entrepreneur jumping into a space that they're not necessarily familiar with?
Well, we have lots of examples of entrepreneurs who've gotten to great places without having had prior experience, from the Apple guys and the Facebook guys and the Google guys and so on. There are lots of examples of that. But there are vastly more examples of entrepreneurs who served a market and found an unmet need in that market and said, I'm going to go solve that, maybe from the perspective of the industry where they worked, or maybe by doing something a bit different than where they worked. But they're serving a market need that they already understand. Or they're in an industry and they find some unmet needs in some customer groups that are not well met by that industry. And they say, I'm going to stay in this industry, but I'm going to go after this little target area, and I'm going to solve that problem there. And then once I build a platform that's successful, then I'll grow from there.
Yeah. So I guess it kind of brings us on to, in terms of analyzing opportunities. So we've kind of talked on having some experience and also that passion to deal with the inevitable challenges that come along. What are some of the other things that investors should be looking at when they're appraising opportunities at whatever level?
Well, I can tell you what I look for. I'm an active angel. First, I look at customer traction. I want to know if there are customers who are buying this stuff, and typically I go try and talk to some of those customers and ask them why they're buying. And I mean real customers, and not the entrepreneur's cousin and his uncle and his and his friends, but real customers. So that's one thing. But more broadly, there's a framework I developed in my first book, The New Business Road Test, called the 7 Domains. And it says we want to look at the market and understand the market. That is the group of customers that you're going to serve. How fast is it growing? How large is it? Are there any trends that are going to keep it growing in the future? That's sort of the macro level, kind of 30,000 foot look at the market. And I want to know that. More important in the market is I want to find some evidence that the customer actually will buy what this particular entrepreneur is offering. So that's why customer traction is so important to me. If there isn't customer traction, then we don't have evidence that the customer is going to buy. And there's enough risk in a new venture, when all the stars are aligned, never mind, taking on the risk when they aren't. So I want that. what an awful lot of investors miss, I think, is the other side of my framework, which is understanding the industry in which that entrepreneur is going to play. So the market is the customer group, who's going to buy, but the industry is other people who deliver what you deliver. That is your customers. And there's a framework Michael Porter at Harvard developed a long time ago called the 5 forces. You need to really understand each of those 5 forces and ask yourself, do I want to be in that industry, or do I want to be an investor in that industry? That's a really important question. And then also on the industry side, you take this one company and compare it to its competitors, and you ask, is there reason to believe that this company can sustain competitive advantage over time? Because the last thing you want to do is back an entrepreneur and then have some company that's got better resources come eat your lunch. And that's a matter of, the entrepreneur of having something that's really valuable to customers, something that's rare that other people don't have. Maybe there's a patent, maybe there's some proprietary processes that give you a head start. And it's something that's hard to imitate, that others can't copy very easily. So I want to know those things on the industry side, and then I look at the team.
Yeah,
and
I think
market, industry, team, that's what I want to understand when I invest.
And a lot of those ones where the big company comes in and eats lunch, I see, is where a business is based around a single product.
Yeah, you can't build a one-product business, but you can start with one product.
Absolutely.
Yeah.
You need to build that ecosystem. Okay, let's talk about exits and liquidity, because as an angel investor, I'm sure you're familiar with the common refrain from entrepreneurs, which is we will exit in 3 to 5 years.
Good luck with that.
The default saying that we're taught at birth. How important to you is knowing the exit strategy or being conscious of that going into a deal?
Honestly, I don't pay much attention to that. And I'll tell you why. The entrepreneur really doesn't know what that exit strategy is going to be, because it's going to happen probably not in 3 or 4 or 5 years. It's probably going to be 7 or 10 years or more. When there are early exits, typically they are not particularly attractive exits. Mm-hmm. So that's not what you're looking for. And if you're thinking that some value is going to be created over 7 or 10 years, that's a long-term game. And most of us don't really know what the world's going to look like in 5 years, never mind 7 or 10 years.
Yeah.
So my view is, if you build a business that turns out to have real value and delivers great stuff for consumers and has some barriers that can protect you, at least for a while, from competitors, and over time can grow, I don't care much whether eventually we exit with an IPO or we exit with a trade sale, or the entrepreneur, gets to a point where he says, this isn't big enough to be an IPO, and maybe it's not going to be a trade sale, but I'd love to just run this myself for a long time, and I want to buy my investors out. So there are lots of ways to get out, and maybe I'm different than other investors, but I don't think that's particularly critical on day one.
Right. Yeah, it's an interesting one. I think any investor I know that's successful has a long-term time horizon. Any investor I know that's poor generally has a short-term horizon, and it's trying to magic returns. All right, very, very good. What are some of the other key things that either that you're seeing, trends that are happening? I mean, I know you are a big believer in, and so am I, of getting customer funding. How important do you see things like kind of crowdfunding and those sort of approaches to finance? Are you seeing them actually making an impact on the businesses that you're seeing day to day, or has that kind of gone away a bit?
Yeah, I don't see it all the time, but I see regular examples. One of my former students did the largest crowdfunding deal that had ever been done at that time, probably 5-6 years ago now, in London, to build a pizza business, and that was a good way to get finance. He learned a couple interesting things from that, though. Lesson number one, if you're going to crowdfund, is did you know you have to bring your own crowd? It only works if you have enough, already kind of ready to tap, so
Yeah.
that you can create some artificial momentum that the rest of the crowd then follows along. So you got to do that.
Yeah.
Secondly, you have to spend a lot of time these days, because it's a more sophisticated game, building a great video, and maybe you need a prototype, and so on. And so all of that costs time and money. And I'm not always sure that that's the best way to spend that time and money. Maybe the better way to spend that time and money, at least some of the time, is to go talk to some customers and really understand what their problems are. And if you can figure out some customer problems that are really compelling, build the product for them, and off you go.
Yeah, I quite like it from the point of view of, if you can't persuade people to put in these forward orders for your product, then perhaps you're not ready yet to be going and talking to investors. Whereas if you can go to investors and say, hey, look, we got 50 or 100 or 1,000 people to put in a pre-order for this product, that's a much more compelling investor proposition than, hey, look, we've got an idea in a 20-slide deck. So I do quite like it from that perspective. Let me just pull you on the pizza the thing because this is the most successful crowdfunding at the time, and it was around a pizza company. Domino's Pizza has been one of the most successful stocks in the US market over the last 10 years. It's outperformed Google, it's outperformed Amazon. It's a quite remarkable story. So a lot of us tend to get excited by the new shiny thing. And yet, there's a lot of great businesses out there just doing a slightly different take on it. Yeah, I mean, you mentioned Starbucks. It's coffee. It was maybe new in America in terms of slightly better coffee than had been served previously. But it wasn't revolutionary by, it's not autonomous cars or anything like that. Do you see in the businesses that you come across, how compelling is it, or do you see a lot of these businesses that are just a slightly different take on an existing idea?
Yeah, often you see that. You see somebody with a clear focus on a target market that wants something that the rest of the market doesn't want. And by focusing on that narrow market segment, you can tailor your offering to serve that market segment better than the more generalist players do. And that's how you build a foothold. And once you get really good at that, you develop a lot of skills around understanding customers and building products to meet their needs. You then can move on into other market segments. So typically, what I see in these mid-sized companies that are growing very nicely is they're doing something better, faster, or cheaper, typically better or faster than other companies are that do the same kind of thing. And that's why they win, because they're better, and because the customer believes they're better, and the customer wants to do business with a company that is better, that delivers on time, that has good customer service, that has fair prices, the quality's there, all that stuff. It's easy to say all that stuff about what we have to do in business. It's pretty hard to deliver it consistently over time. And if you build a business that does, you get rewarded.
Yeah. No, it's incredibly difficult. Okay, so we'll wrap up. Now, obviously, we would recommend that investors read all three of your books. But if they were going to pick, which was the first one for them to get into to help them?
Well, if they want a framework how to think about investments, as I mentioned before, the New Business Road Test is a book that articulates these 7 domains that help you look dispassionately and in a systematic way at an opportunity and ask yourself, why might this work? Or more critically, why won't this idea work? And that identifies the risks for you, and then you can try and get some due diligence done around those risks and see if you can get comfortable taking what risks remain. So that's the one that most investors look at first of my work.
Okay, so let me just talk about the framework for a second, because I found one of the most useful things for me in investing was when I started saying no to a whole segment of the market. So for me, um, when I started turning down anything that was startup or early stage, my investments got much more, my returns increased massively, because up until that point, I was getting distracted by, I'm an entrepreneur.
Shiny things. Yeah, right.
I can see the potential in everything, right? So, but it wasn't very useful because, yeah, and the more of these things I looked at, the more popped up on my radar, and suddenly, like, you just can't do anything. So when I said, okay, look, I'm not going to um, look into a particular area, and for me that was startup and early stage, but that really allowed me to focus and become, um, master, but become a lot more switched on in the area that I want to see those results. Is that something that you've applied to yourself? Because you must obviously see a lot of opportunities. Do you have a kind of a personal triage on what you will and won't look at?
Well, I think I have two or three sort of cuts. One is that I want to see customer traction, revenue. I mentioned that before. The second one is that I typically invest either in things I understand,
Mm.
something that I've, done business with in some way or another before, and I really understand how that part of the economy works, or people I understand and know well. So I've invested often in my past students because I've come to understand their skills,
Yeah.
and they've developed some ideas at London Business School while they're there, and we've had some pretty nice rides, as a result of those ideas. So those are the things that kind of
Yeah.
do me. I don't like to invest in something that is gee whiz, but I have no idea how that industry works, and I've never seen that person before.
Yeah.
I don't do that.
Yeah. No, very good. Very good. All right. Excellent. Well, thank you for that. It was some great insights there. I guess if you could just leave us with, it's 2020. It's a fairly exciting year. That this video
Mm.
will be coming out in May. We're filming it in March, which is interesting times. But kind of getting away from the day-to-day stuff, in terms of kind of the next decade, what are some of your thoughts about what's happening in the next decade that investors can look at?
Well, I think the digital world is going to continue to have an awful lot of impact. Stuff is going to get disrupted, as they say, with digital ways to do things that are just vastly more efficient than the old ways are. And we're going to see that in industry after industry. So to the extent that you can find somebody who understands the digital world, but also understands the customer in some particular arena, those are going to be pretty interesting opportunities, I think.
Yeah.
I think one of the rules I have for investing is I like to invest in what I call lines, not dots. So, if somebody makes a presentation at a particular point in time, that's a dot in a particular point in time. Then I want to see that person again in a while, and that's another dot, and has some progress been made? Well, pretty soon there's a bunch of dots, and if those dots begin to look like a line, and that line's going in the right direction, then maybe that's the time to get on board with that venture.
Yeah, very good, very good. Great advice, very useful for investors looking into that growth space, and ultimately that's where the really big alpha comes, if you can find those winning
Yep.
companies. So thank you for that, John. I really appreciate it. We'll put links to all your books down below. But great insights there, and yeah, thank you very much for your time. Much appreciated.
And thank you, Callum. Good fun.
Yeah, cool. Pleasure.
See ya.